Hello everyone, I have a paradoxical point to make. What if decentralization is a double-edged sword? What if in some cases it cuts you out of profitable deals? Yes. Hop in and I will explain myself. Be sure to watch the video until the end, for I will show you how to approach the decentralization factor without missing out from juicy opportunities. But I want to start with a question. Yes, for us in crypto, decentralization is a sacred call, no doubt about that. But will you be ready to invest in a promising project knowing that its decentralization is compromised? Write your honest opinion in the comments. As for me, I would, but not without making proper analysis first. For example, if from a technical standpoint the coin looks good, I would surely think of buying it if it's believed to be lacking in the decentralization department. The first thing I would do, of course, is try to evaluate how serious the problem is. How the news and rumors about such a decentralization affect the market sentiment. If not by much and technical analysis seems good, I myself would consider buying. Let me tell you a secret. There is no obvious correlation between an asset centralization and its price dynamics and capitalization. I will try to prove that by using the Nakamoto coefficient. This metric is rather an ambitious attempt to quantify the level of decentralization of certain blockchains. Zyme prefers listing the main subsystems of a decentralization system. Then it's determined how many objects need to be compromised to control each subsystem. And then finally, the minimum of them is used as a measure for effective decentralization of the system. What is system and subsystem, you would ask? In the logic of the index, a decentralized system, like for example Bitcoin, consists of a set of decentralized subsystems. These include mining, dApps, exchanges, codebase, nodes, and owners. In fact, all subsystems must be decentralized, otherwise we cannot talk about the decentralization of the system itself. The coefficient treats all the subsystems equally in the sense that they all can equally affect the outcome. To calculate the coefficient, it is necessary to determine how many objects in each subsystem must be controlled by unscrupulous players in order to pose a threat to decentralization. The more of these objects, the higher the coefficient will be. And the higher the coefficient, the more troublesome it would be to compromise the decentralization. Yes, there are many questions about such a methodology. First, why exactly do we choose these particular subsystems and why do we treat them equally? For example, why are exchanges as important as mining? In the case of Bitcoin safety, it can technically survive trouble with the exchanges, while the failure in mining may bring it down. Another problem is the ambiguity in the methodology. For example, how to calculate the coefficient for mining. Let's take Bitcoin. To compromise the Bitcoin network, you need to take over 51% of the hash rate. How many players are needed for this? According to current data too, Foundry USA and Antpool mining pools whose total share in the hash rate is 54.5%. Does this mean that Bitcoin's Nakamoto coefficient is 2? Well, technically yes, but not quite. Miners can freely leave pools. They have the opportunity to refuse to participate in unfair actions at any time. So in fact, everything doesn't depend on the decisions of two players. Then how to calculate? Well, you can take half of the number of nodes in the network, but this approach actually has a problem too. The nodes are not equal to each other. In general, no matter what calculation method we choose, it will still be questionable. Having said that, I must add that despite all the problems with the methodology, we have no better coefficient to measure the decentralization. So let's stick to it. For example, if we look at Naka coefficient of the Ethereum, it was given by some assessment to value of 2, which far worse when compared to Solana and Avalanche, which score around 30. However, we understand that Ethereum is much more scalable, even though on paper, specifically in this task, its two competitors may appear more reliable. Another drawback of such indices and decentralization measurements is that values will change over time. This is related to the project's roadmap and that controversial methodology. In any case, there is a clear example here, Solana. Previously, the index was around 30, but over time it dropped to about 18. This means it is not a constant, and one must always conduct and deduct their own analysis. The peculiarity of the situation is that this doesn't doesn't always help to make a profit. To illustrate my point, let me give an example. The Mina project, according to the index, receives a decent score of 169 points. If you believe the developers, it is a lightweight and decentralized zero-knowledge blockchain. Security and anonymity are important pillars of decentralization, but is it really a good way to earn money? It's debatable. The fact is that since around March 2024, the coin has been decreasing in price. It was trading above $1.50 at that time, and by August the price could drop below 50 cents. Is it a good coin for investments over a few months? I don't think so. Of course, something might change in the long run, but investing in Mina for growth in March was definitely a bad idea. That's a fact. Although from the perspective of the Nakamoto index, the project is successful. Press like if you value decentralization, no matter the profitability. Does this mean that decentralization as a criterion for choosing a project to invest in is not important at all? This statement is also incorrect. Cryptocurrency was conceptually designed as a decentralized tool, and it's precisely decentralization that distinguishes cryptocurrency from traditional financial solutions, allowing us not to trust centralized market participants. So why should we pay attention to decentralization at all? In this sense, decentralization is important as a means of transferring money from person A to person B. That is, decentralization is needed when we use cryptocurrency literally for its intended purpose. Making transaction and possibility using it is a kind of deposit for our savings. In other words, we store money in crypto for the long term instead of in a bank. Even when we become holders and save our assets over the long term, cryptocurrency is important to us as a decentralized tool, because if it turns out that the tool is centralized, it puts our savings at risk of hacking and loss. What am I getting at? I mean that if we are interested in cryptocurrency not just a way of trading and making money here and now, then we better share the love for decentralization. However, if we don't care about the technology and just want to profit from the most favorable instruments at the moment while being aware of all the risks of using that instrument, then decentralization is not a necessity. Thus, I would differentiate investment tools based on the significance of decentralization. As I mentioned at the beginning, it is not that important solely for profit, but if we're investing in a truly serious long-term project and our goal is long-term storage of cryptocurrency or even its literal use as a means of payment, then it's better to look at the technical features of the project in terms of decentralization. In this sense, the Nakamoto index serves merely as an auxiliary tool. It shouldn't be overvalued or ignored. On one hand, if we focus on a high decentralization value, we may choose an unsuccessful project to make a profit. If we completely ignore this value, we will face certain risks. Please write in the comments whether you factor decentralization in your decision making. Yes, you often hear that decentralization is everything, but if we place it at the forefront, we can literally deprive ourselves of interesting opportunities. After all, if there were such a convenient, simple, and clear index that could immediately indicate the prospects of a project, everyone would have been millionaires long ago, right? The moral here is that, unfortunately, there are no simple and unambitious solutions in the crypto market. One must do his own research and keep in mind which coins are serious and which are just momentarily high. So guys, this was Michael with you today. Don't forget to like, push the notification button, and subscribe. See you next time. Bye.